Welcome to this week's Financial Flash for June 27th, 2025. I'm Paul Tickey, and today we're talking energy and why gas prices, summer travel, and geopolitics are more connected than you might think. As we head deeper into summer, travel is surging. AAA expects tens of millions of Americans to hit the road or fly for vacations, and that kind of demand puts real pressure on gasoline and jet fuel prices. More demand, especially around holiday weekends, often means higher prices at the pump. It's basic supply and demand, and this time of year, demand always wins. You've probably noticed this already. Gas prices typically rise in late spring and peak midsummer before cooling off in the fall. But in 2024 and 2025, other factors are adding extra fuel to the fire. Energy markets are also notoriously volatile, and it's not just about driving and flying. Prices can swing quickly based on things like extreme heat, which boosts electricity demand, or refinery issues, which limit supply. This summer, the potential for hurricanes in the Gulf Coast, where many U.S. refineries are located, adds another wild card. Crude oil, the base for gasoline, is also bouncing between supply concerns and demand optimism. Traders are constantly reacting to small shifts, whether it's a weather forecast or a change in inventory reports. Now, let's talk geopolitics, because global tensions can move energy markets faster than almost anything else. Conflicts in the Middle East, like those involving Iran or disruptions to shipping routes in the Red Sea, can quickly choke oil supply or create uncertainty. Even Russia's war in Ukraine continues to reshape global energy flows, especially in Europe. Just a few headlines, like a drone strike on a pipeline or a new round of sanctions, can send oil prices up by several dollars a barrel overnight. That eventually trickles down to what we pay to fill our tanks. So what's the takeaway? If you're traveling this summer, don't be surprised if prices feel a bit jumpy. Global markets, weather, and politics all have a hand in where energy goes, and we're seeing that play out right now. For investors and everyday travelers alike, energy remains one of the most unpredictable yet most impactful sectors to watch. But before we wrap up, let's talk quickly about why we like energy stocks as part of a diversified portfolio. Energy companies, especially the big players like, but not limited to, ExxonMobil or Chevron, will tend to generate strong cash flow, pay solid dividends, and can act as a hedge against inflation. When oil and gas prices rise, these companies often benefit, which can help offset losses elsewhere in your portfolio, like in consumer or tech sectors that suffer when costs go up. Energy also adds sector diversification, which we talk about frequently with our clients. It doesn't always move in sync with the broader market, which is exactly what you want when trying to manage risk. And with the world gradually shifting toward renewables, there are also emerging opportunities in clean energy and infrastructure plays that sit alongside traditional oil and gas investments. Bottom line, energy can be volatile, but in the right allocation, it can add balance and income potential to a long-term portfolio. That's your energy market snapshot. If you found this helpful, drop a comment or share it, and we'll see you next week with another Financial Flash report.
The Financial Flash is created by the experts at Styles Financial Services, creating customized portfolios that fit your unique lifestyle and goals.